In early July, a 25-year-old former OpenAI researcher ran the hottest hedge fund on Earth. Leopold Aschenbrenner's situational awareness had peaked near $45 billion, up roughly 80% for the year. His thesis was simple, and it was right. AI infrastructure was the trade of the decade, so he leveraged it hard, as much as 4 times. One concentrated bet on a handful of AI chip and data center names, SK Hynix, CoreWeave, Nebius, Micron, Bloom Energy. That bet was correct in every way except one. It was leveraged. And leverage is the one thing a correct thesis cannot survive. In early July, a 25-year-old former OpenAI researcher ran the hottest hedge fund on Earth. Leopold Aschenbrenner's situational awareness had peaked near $45 billion, up roughly 80% for the year. His thesis was simple, and it was right. AI infrastructure was the trade of the decade, so he leveraged it hard, as much as 4 times. One concentrated bet on a handful of AI chip and data center names, SK Hynix, CoreWeave, Nebius, Micron, Bloom Energy. That bet was correct in every way except one. It was leveraged, and leverage is the one thing a correct thesis cannot survive. The numbers are staggering. By early July, situational awareness had grown to $45 billion, a quarter-century-old fund run by a former OpenAI safety researcher. It was up about 80% for the year. The portfolio was not diversified. It was a single thesis loaded with leverage, SK Hynix, the world's top maker of HBM memory for AI chips, with a $7 billion cornerstone stake in its July 10th US IPO, plus CoreWeave, Nebius, Micron, Bloom Energy. The fund didn't just bet on AI, it borrowed to bet on AI reports, put the leverage as high as 4 times. Then the reversal. In July, the AI trade hit a momentum shock. AI infrastructure and semiconductor stocks fell between 35% and 47%, a violent, fast drawdown in a small, crowded corner of the market. For a normal fund, a 35% haircut on a good thesis is a bad quarter. For a fund running 4 times leverage, it is a wipeout. A 4 times levered book that falls 35% loses 140% of its equity. There's no recovery from that. The only question is how the forced selling happens. The margin calls came from the prime brokers, Goldman Sachs, JP Morgan, Bank of America. When your borrowed money loses value, the bank demands more collateral. When you have none, the bank sells for you. The fund had sustained losses of roughly 2/3 of its value in July alone. The public book had to go on July 30th. After an overnight bidding war, Ken Griffin's Citadel stepped in and bought roughly $16 billion of the portfolio at a substantial discount. The move stabilized AI stocks. It also crystallized one of the great forced sales in market history. Now, the part most coverage missed. The same week, on the other side of the world, the same mechanism was running in reverse through the Korean retail market. The KOSPI is the home of SK Hynix, the exact stock at the center of the Aschenbrenner unwind. In July, the KOSPI fell about 29%, the worst month in its recorded history, beating even the 27% collapse of October 1997. From its June peak, it lost more than 1/3 of its value. It tripped 8 emergency circuit breakers on a single day, July 28th, and erased roughly 250 trillion won of market value. The KOSPI crash is not a separate story. It is the mirror image of situational awareness. In the US, an institution borrowed 4 times to bet on AI chips. In Korea, retail investors borrowed to bet on the same chips. The trigger was the launch of single-stock leveraged ETFs in late May 2026. Within weeks, Korean retail poured roughly 14 trillion won, about $9.4 billion, into these leveraged products against just 2 trillion from foreign investors. Same asset, same leverage, same margin calls, same vicious cycle, just with tens of thousands of small accounts instead of one giant one. Here's the insight the news missed. Leverage is not a bet on a thesis, it is an amplifier of the margin base. When prices fall, leveraged holders do not have the luxury of waiting for their thesis to play out. They are sold out mechanically at the worst price by someone who does not care about AI. The forced selling feeds the decline, which triggers the next margin call, which forces the next sale. This is the autocatalytic spiral. A small, correct, concentrated bet, magnified by leverage, becomes a machine that destroys itself. And the second insight, the retail layer turns a fund collapse into a market-wide event. In Korea, the launch of leveraged ETFs handed retail investors the same 4 times bet as Aschenbrenner was running, with none of the risk management. When the same asset falls, the retail margin calls cascade into the index itself. KOSPI's 8 circuit breakers in one day are what a 2-sided leverage spiral looks like. Institutional forced selling from the US fund colliding with retail forced selling in Seoul, both dumping the same SK Hynix. The counterargument is worth taking seriously. A skeptic would say this was not a structural failure at all, just an overvalued AI trade that corrected, and Citadel simply bought cheap assets. There's truth there. The AI stocks were expensive, and a drawdown was overdue. But that argument misses what actually happened. The fund's thesis was not wrong. AI infrastructure genuinely is the defining trait of this decade. The thesis survived. What died was the leverage. A correct bet, financed with borrowed money and no margin buffer, is still a margin call waiting to happen. The crash was not a failure of prediction, it was a failure of structure. There's a final echo worth sitting with. The last time KOSPI fell this hard was October 1997, the Asian financial crisis. Then the leverage was Korean chaebols borrowing foreign currency to build steel, ships, and memory. Now it is Korean retail borrowing to buy AI chip ETFs, and an American fund borrowing to buy the same chips. Same country, same index, same margin dynamics, 29 years apart. The asset changed. The machine did not. In 1997, it was semiconductors too. Samsung was selling memory into a glut. The lesson is not new, it just wears a different ticker. So what does this mean for you? 3 things. 1, when you hear about a brilliant investor with a leveraged thesis, ask not whether they are right, but how much they borrowed. 2, whenever a new leveraged product is offered to retail, a single stock ETF, a margin account, a Forex fund, you are being handed the same mechanism that just emptied a $45 billion fund and a national index. And 3, the safest way to be right about the future is to be unkillable while you wait for it. No leverage, no forced exit, no margin call. You can hold a correct thesis for decades. Leverage cannot hold it for a week.